When you check silver's price on your phone right now, you're looking at $61, $62 an ounce. That's the number everyone quotes. That's the number every financial app shows you. But here's the thing. Almost nobody's telling you. In Dubai, buyers are actually paying 38% more than that number for real physical silver, not 38 cents more. 38%, that's a gap of roughly $23 per ounce. Between the price your phone shows you and the price a buyer in one of the world's most important physical precious metals trading hubs is actually paying. In the real world, right now, today. This gap between what the paper markets say silver is worth and what people are actually paying for the real thing in physical markets is one of the most important and least understood stories in precious metals right now. And once I explain exactly how this happens, why it's happening specifically now, and what China just did to potentially make it much, much worse, you're going to look at that $62 number on your screen very differently. This is OG Silver Stacker. Every video, something genuinely new. Let's go. Let's start from absolute basics. Because I think this is a moment where getting the foundation exactly right matters more than rushing ahead. The price you see quoted for silver on any financial website, app, or news channel is called the spot price, and it comes from the futures market, specifically the COMEX exchange in New York. This is the price at which standardized silver futures contracts are currently trading. These are paper contracts. Legal agreements between two parties to exchange a specific amount of silver at a specific price at a specific future date. Here's the critical detail most people never think about. The vast majority of these paper silver futures contracts never actually result in physical silver changing hands. Studies of COMEX trading activity consistently show that somewhere between 97 and 99% of all silver futures contracts are settled financially, meaning the contract gets closed out before delivery is ever required, with the buyer and seller simply exchanging the difference in cash between their agreed price and wherever the market actually ends up. Only 1 to 3% of contracts ever result in actual physical silver being delivered from an actual vault. This means the spot price you see on your screen is primarily being set by an enormous amount of financial activity, involving paper contracts that never actually require anyone to pick up real silver and hand it to someone. The price is set by traders, hedge funds, algorithms, and institutional investors, who are mostly interested in the financial exposure to silver's price movement, rather than in actually owning the metal itself. This is a completely legitimate market structure. It's how virtually all commodity futures work globally. But it means the price signal you're reading is shaped primarily by financial activity, rather than by what's happening in the actual physical market where real metal changes hands. Now let's understand why physical silver always costs more than spot. Before we get to why the gap is currently enormous, whenever you buy actual physical silver, whether coins, bars, or rounds, you pay the spot price plus a premium. A base level of premium always exists because turning raw silver into a finished, deliverable physical product costs real money. A refinery has to melt silver down, purify it to the required fineness, cast or press it into the specific bar or coin shape, stamp it with the weight, purity, and identifying marks, quality check it, package it, insure it, store it, and eventually ship it to a dealer who then adds their own margin before selling it to you. All of these steps cost money, and those costs get passed along to the end buyer through the premium. Even during normal market conditions with no unusual supply pressure, a basic government-minted 1-ounce silver coin typically sells for somewhere between $2 and $4 above spot price, simply to cover these legitimate production and distribution costs. But here's where things get genuinely interesting and directly relevant to today's video. The premium above spot isn't fixed. It fluctuates based on physical supply and demand conditions, in a way that's largely separate from what's happening in the paper futures market. When demand for physical silver suddenly surges, or when supply of physical metal gets disrupted, or when buyers in certain regions face unusual constraints on accessing physical metal through normal channels, the premium can spike dramatically, creating exactly the kind of gap between paper price and physical reality that we're seeing in Dubai right now. Dubai is not some random peripheral precious metals market. It's actually one of the most important physical gold and silver trading hubs in the entire world. Dubai serves as the primary precious metals trading gateway for enormous amounts of demand flowing from South Asia, particularly India, Pakistan, and the broader South Asian diaspora, from the Middle East itself, from East Africa, and from various parts of Southeast Asia. Huge volumes of physical gold and silver that eventually end up being consumed across this massive geographic and demographic footprint pass through Dubai's physical market first. The Dubai price premium for physical silver of approximately 38% above the COMEX spot price tells you something genuinely important. Buyers in one of the world's major physical silver trading centers are so eager to get their hands on actual physical metal that they're willing to pay nearly 40% above the paper price to secure it. That's not a rounding error or a minor market quirk. That's a screaming signal that the physical supply of real deliverable silver is significantly tighter than the paper market's headline price is reflecting. Here's a way to think about what this gap actually means in practical terms. If you could somehow buy silver at the paper spot price and immediately sell it at the Dubai physical market price, you'd make a 38% profit overnight. In a perfectly functioning, fully connected global market, this kind of arbitrage opportunity shouldn't persist for long, because traders would quickly exploit it by buying cheap paper silver, converting it to physical, and selling it at the Dubai premium, which would push the paper price up and the physical premium down until the gap closed. The fact that this gap is persisting tells you that there's a genuine constraint preventing this arbitrage from working smoothly in practice. Real physical silver is either too difficult, too slow, or too expensive to move from where paper contracts are settled to where physical buyers actually need it. Now, let me walk you through something that has received almost no mainstream coverage, despite being one of the most significant silver supply developments of the entire year. China implemented restrictions on silver exports that effectively limit legal silver export to just 44 specifically approved companies. This isn't a complete ban on silver exports, but it's a dramatic reduction in the number of entities legally permitted to move silver out of China, combined with a requirement to obtain specific government export licenses for each transaction. Why does China's export policy matter so much for global physical silver supply? Because China is one of the world's most important silver-producing, refining, and consuming nations simultaneously. China both mines significant quantities of silver as a byproduct of its vast mining industry, and operates some of the world's largest and most modern silver refining facilities. For years, Chinese refining capacity has processed raw silver ore from mines around the world, and returned finished silver bars and other products to global markets, a dramatic restriction on which companies can legally export this refined silver out of China directly constricts the pipeline through which Chinese refined physical silver reaches global physical buyers. There's an additional layer to this China story that's even less well known. China also implemented restrictions on the export of sulfuric acid, which is a critical chemical used in the silver refining process globally. Sulfuric acid is needed to separate and purify silver from the mixed metal concentrates that come out of most mining operations. When sulfuric acid supply gets restricted, silver refineries outside of China face higher input costs and potentially reduced processing capacity, which indirectly constrains the global production of refined, deliverable physical silver, even at mines and refineries that have nothing to do with China directly. This kind of second-order supply chain effect rarely gets covered in mainstream precious metals content, but it's exactly the kind of hidden constraint that can create significant physical supply tightness, without showing up, obviously, in the headline mining output numbers. Let's bring in another piece of independent confirmation for this physical tightness story. Because having multiple separate signals all pointing in the same direction gives you much more confidence than any single data point alone. The Shanghai Futures Exchange, often called SHFE, is the primary commodity futures exchange in China, and one of the most important precious metals trading venues in Asia. Silver traded on the SHFE has been running at a premium of approximately 12 to 13% above the COMEX price for an extended period. This SHFE premium is distinct from the Dubai premium and worth understanding separately. While the Dubai premium reflects physical demand pressure from South Asian and Middle Eastern buyers accessing silver through a physical trading hub, the SHFE premium reflects the price Chinese domestic buyers and institutions are willing to pay specifically within China's own trading system. A 12 to 13% premium on a major exchange, sustained over time, tells you that demand from within China itself for silver is meaningfully exceeding what the global paper price reflects. Here's where the China export restriction becomes particularly important for understanding this SHFE premium. When China restricts the export of silver to just 44 approved companies, it creates a situation where Chinese-produced silver that might otherwise flow outward to global physical markets instead tends to circulate more within the Chinese domestic market. This can paradoxically help sustain the domestic SHFE premium even while it constrains global physical supply outside of China. The two dynamics, premium inside China and physical tightness outside China, are actually connected to each other through the same export restriction mechanism. Let's shift from the physical market story to something on the technical side that's equally important for understanding what happens next. Multiple analysts, including Commerzbank, whose year-end $90 target is the cleanest institutionally backed bull case currently circulating, have specifically conditioned their bullish outlook on one precise technical event: a weekly close above $65. Let me explain why this specific level matters technically in plain terms. Because the reasoning behind technical price levels is often treated as mysterious or purely arbitrary, when it's actually grounded in how markets track and remember price history. Silver's most recent sustained support level, the floor that held for several months after the dramatic January crash, was in the $64 to $65 range. That level held repeatedly from approximately December 2025 through mid-June 2026, meaning every time silver fell toward that zone, buyers stepped in and defended it. When silver broke below that level decisively in recent weeks, it turned what was a floor into a ceiling. Meaning the same price range that used to act as a support, attracting buyers, now acts as resistance, attracting sellers who want to exit positions they'd held since before the breakdown. A weekly close above $65, meaning silver not just briefly touching that level intraday, but actually sustaining above it for a full weekly settlement, would represent the market reclaiming that previously broken support level, turning what's currently acting as resistance back into confirmed support. When a market successfully reclaims a previously broken support level and holds it, technical traders treat that as one of the clearest signals available that the trend has genuinely reversed, rather than just bounced within a continuing downtrend. This is the precise technical event that Commerzbank's $90 target is waiting for before activating. And it's the technical setup that multiple other institutional forecasts have explicitly made conditional on occurring. Here's something that's been surfacing more frequently in serious financial research this week, and I think it deserves honest, direct attention, because it represents one of the more uncomfortable possible scenarios for the broader economy. And understanding it changes how you think about silver's role in a portfolio. Multiple analysts and researchers are now explicitly drawing parallels between the current economic environment and the stagflation period of the 1970s in the United States. Stagflation, in plain terms, is the combination of stagnant economic growth alongside persistent inflation. The reason this combination is so difficult for policymakers is that the normal tools for fighting each problem actually make the other problem worse. Fighting inflation requires raising interest rates, which slows economic growth and can push a stagnant economy into recession. Fighting stagnant growth requires cutting interest rates or increasing stimulus, which tends to accelerate inflation. When both problems occur simultaneously, the central bank faces a genuine trap with no clean solution available. Here's the direct connection to silver and gold specifically. During the 1970s stagflation period in the United States, gold and silver were among the very few asset classes that performed powerfully, because they responded to the combination of economic uncertainty and persistent inflation in ways that traditional stocks and bonds, both of which struggled during that period, did not. Gold surged from roughly $35 an ounce in 1971 to nearly $850 by January 1980. Silver's performance was similarly dramatic. Investors who understood the stagflation dynamic and positioned in precious metals early in the 1970s cycle did extraordinarily well, compared to those who stayed in conventional financial assets through that period. The Fed being described as trapped in current analysis refers specifically to this same dynamic. With the June jobs report showing only 57,000 jobs added, the growth side of the equation is clearly sending warning signs. But with inflation still running well above target, and the Fed's own internal 2026 forecast recently revised up from 2.7 to 3.6%, the inflation side is also clearly still a live problem. This combination is exactly the stagflation trap dynamic. And its increasing prominence in serious institutional analysis is one of the most important structural reasons some analysts maintain very bullish precious metals outlooks, despite the recent price weakness. Let me give you genuine historical context for what happens when these kinds of large premiums between paper and physical silver persist for extended periods, because the historical pattern is genuinely useful for calibrating your expectations about where things go from here. Large, sustained premiums of physical silver over paper silver have historically resolved in one of two ways. The first, more common resolution, is that the paper price rises to close the gap, catching up to where the physical market is already trading. As institutional money in the paper market gradually wakes up to the physical supply tightness that retail physical buyers were experiencing long before it shows up in the futures price. This is the bullish resolution scenario, where the paper price eventually reflects what physical buyers are already paying, effectively moving the headline spot price up toward where the real-world transaction price already is. The second, less common resolution, is that the physical premium itself compresses downward back toward the paper price, usually through some combination of increased supply reaching physical markets, reduced physical demand, or large holders of physical silver deciding to sell into the elevated physical price premium and collect the arbitrage profit. This resolution scenario requires actual physical silver to be mobilized and moved to where the premium is highest, which in practice takes significant time and logistical effort, meaning even if this resolution eventually occurs, the premium tends to persist for considerably longer than most casual market observers expect before it actually closes. The Dubai 38% premium and the SHFE 12 to 13% premium together represent a level of sustained physical over paper premium. That, in historical context, has typically been a leading indicator of upward pressure on the paper spot price, rather than a leading indicator of physical premium compression. When two major physical trading hubs are simultaneously trading at large premiums for extended periods, the historical pattern says the paper price catching up is the more probable resolution, rather than real-world buyers suddenly settling for less than they've been paying. This doesn't provide a timeline. Markets move when they move and not on our preferred schedule, but it does provide directional context that I think matters enormously. Let's bring this together practically. If the Dubai 38% premium and SHFE 12 to 13% premium tell us anything useful, it's that the price on your screen right now is systematically understating what willing, motivated buyers are actually paying for physical metal in two of the world's most important physical trading hubs simultaneously. This doesn't tell you exactly when the paper price will catch up to physical reality, but it does tell you something important about the underlying supply and demand balance in the actual physical market. For a physical stacker making decisions about when and how much to buy, understanding this gap has a specific practical implication. When the physical premium over spot is elevated in global markets, buying physical silver locally at your dealer's normal premium above spot is actually a relatively better deal than it looks. Compared to what buyers in globally important physical trading hubs are paying for the same metal, your dealer's premium of $2 to $4 above spot looks modest. Compared to what's actually happening in Dubai and Shanghai, the China export restriction adds a structural dimension to this story that's worth sitting with carefully. If China is limiting silver exports to 44 companies while simultaneously restricting the export of the sulfuric acid needed for refining elsewhere, the physical supply constraints we're observing in Dubai and Shanghai aren't just temporary market timing quirks. They reflect supply chain restrictions with real-world physical causes that can't be resolved simply by the future's price adjusting. Physical bottlenecks require physical solutions, specifically more metal reaching the markets where it's needed. And the regulatory and logistical constraints involved mean those solutions take time to implement, even after the financial incentives to do so are clearly present. Combine the physical tightness with the $65 weekly close trigger we discussed, and you have a specific, watchable technical event that could serve as the catalyst for the paper market to begin catching up, to where the physical market has already been pricing silver for weeks. Keep that level front of mind as markets open this week. So here's the full picture behind that 38% Dubai premium. The price on your screen is set primarily by paper contracts, most of which never result in actual physical silver being delivered. The real-world price that motivated physical buyers are paying in Dubai, one of the world's most important physical silver trading hubs, is 38% above that paper price right now. In Shanghai, the premium runs 12 to 13% above COMEX. China's restriction of silver exports to just 44 approved companies, combined with its sulfuric acid export restrictions affecting refining capacity globally, represents a physical supply constraint, with real regulatory and logistical routes that can't be instantly arbitraged away. And the historical pattern says that large, sustained physical premiums like these have typically resolved by the paper price rising to meet physical reality, not by physical buyers suddenly settling for less. The $65 weekly close is the specific technical trigger to watch this week. Above it, the structural bullish case from multiple institutional analysts activates. Below it, consolidation continues. But in either case, the physical silver market, the one measured in real metal changing hands in Dubai and Shanghai, is already pricing silver significantly higher than the number on your phone. If this kind of deep physical market analysis, the kind that goes behind the screen price to what's actually happening in the real world, is what you come to OG Silver Stacker for, hit that like button. Subscribe so you catch the next breakdown. And tell me in the comments, did you know the physical price in Dubai was this far above spot price before watching this video? I read every comment, and I'll see you in the next one.